We have a biotech buyout, obesity drug news, a big pharma making big changes, and an Obamacare apology. This is your market checkup. I know everyone wants to probably start with the Obamacare apology and maybe some of the big pharma news, but let's go to biotech where we have a lot of movers and shakers, and let's start with a buyout. Salix Pharmaceuticals, which is a gastrointestinal disease drug maker, is acquiring Santaris for roughly $2.5 billion to gain that company's diabetes and heartburn related drugs. Now, Santaris' product sales from last quarter were about $98 million, up 83% year over year, and for 2013, the 9 months so far, they're up about 45%. And this looks like a really good purchase for Salix. It's going to be immediately accretive, and this is why shares are up for both. Normally, the acquirer trades down while the acquiree trades up. Not in this case. Salix shares are up 16%, while Santaris is up 38%. Now, Santaris investors may feel frustrated, but you are being taken out at an all-time high and a decent premium. And despite Santaris' huge run, this is a company that had patent cliff issues with Glumetza. Analysts estimated about $220 million in 2015 sales, but what about 2016 sales? I would expect them to be noticeably lower since Lupin will have a generic in February of 2016 and Sun will have one in August of 2016. Now, Watson is currently in a legal dispute and they could have a generic on the way as well. Zegerid is marketed by Merck in the US and GlaxoSmithKline internationally. Analysts see over $100 million in sales there. So there are some nice products. Santaris has a pipeline as well that's a bit interesting. So it's a nice boost for Salix, and they get some complementary products without overlapping and cannibalizing sales. The total company will have roughly 22 products. And this is not even the first immediately accretive deal we've seen this month. There was another one with Endo Health buying Canadian company Paladin Labs. Now, it's sort of the opposite way here. Endo was actually dealing with its own patent cliff issues, so by adding Paladin, it's helped spur them on. They also got a nice tax advantage status by moving the company to Ireland, but we'll probably continue to see deals as these smaller companies deal with their patent issues. It's not just a big pharma problem. All right, so moving on to our next story, we have Arena Pharmaceuticals, and shares are up nearly 20% on the news. Its marketing deal with partner Eisai is going worldwide. So in addition to their current sales agreement, which includes North America, this worldwide deal comes with a $60 million upfront payment for Arena and roughly $175 million in potential milestones. And it now has the rights to Belviq, its obesity drug, in all but 5 countries. Now, Eisai also announced plans to double Belviq's U.S. sales force to 400 reps by the end of the year. Shares of Arena soared on that news a little while ago, but this was largely met with some skepticism. Now, given the prescription data to date and only about 3.3 million in third quarter sales, a lot of people were seeing this more of a jumpstart situation rather than struggling to keep up with the demand of a runaway success. However, Eisai is clearly committed. If they were worried, they would not be throwing additional money for the global rights of a poor-selling product. So, they're also looking for additional indications for Belviq, including smoking cessation and a new formulation of it that would only need to be taken once a day. So, when we're taking a look at the obesity drug space, we also have to take a look at Arena's competitor, Vivus. They've been struggling recently. Shares plunged over 12% when they announced that net product revenue from its obesity drug, Qsymia, was only $6.4 million. That's still almost double Arena's, though. Now, that shows 35% quarter-to-quarter growth, but clearly not fast enough. And it's interesting, Vivus's management said they welcome Arena's competition without naming them specifically. They said the lack of doctor education was the #1 impediment to sales growth. It looks like Eisai may be thinking the same thing, and that going with such a large sales force will help spur sales, and they won't just be trying in vain to convert doctors. So it's going to be interesting to really watch. Neither have been great performers. Vivus is down by a third over the last 6 months. Arena has been cut in half. I think we I think investors need to wait to see sales start turning in the right direction. Otherwise, it's a battle investors would probably be better served by picking neither side. So let's move on to our big pharma news of the day. Bristol Myers Squibb is potentially undergoing a radical transformation. It's been reported that they will be discontinuing drug discovery in 3 areas: hepatitis C, diabetes, and neurological disorders. They will be shepherding pipeline assets that were already discovered through drug development, but there will be nothing new in those treatment areas. Now, this looks radical on the surface. These are huge treatment areas. Diabetes is one of the biggest. That's why all the big pharmas are in it. So is this really a radical change? Now, Bristol is saying the reorganization is about R&D strategy and not about cost cutting, and the amount of cuts does speak to that. It's only about 75 positions eliminated, or 1% of the company's workforce. Now, Bristol did spend about $3.7 billion in R&D last year, which is about 20% of their budget or of their revenue. But let's take a look at each of those treatment areas, starting with hepatitis C. Bristol lost their chance to be a leader here when their nuke showed safety problems and was permanently shelved. They no longer have everything you would need for a hepatitis C drug cocktail. They've given the lead instead to Gilead, who is sofosbuvir. It's the only nuke that actually made it through successfully clinical trials. It's under FDA review right now. Merck is also working on a drug cocktail without a nuke, but it just posted 90 to 100% cure rates. So, this is what you have to remember. These are cure rates, not a captive population that's going to keep taking your drug or slightly improved on drugs. The market is only going to go down once Gilead and Merck and some of these other companies get out there with their treatments. So, it's a huge market, and it's going to be incredibly important to Gilead, but it's going to be increasingly less important as time goes on. Now, in diabetes, Bristol has a partnership with AstraZeneca, but investors need to ask, where's the success? They've spent billions on purchasing amylin for Byetta and Bydureon, but they aren't really gaining as much traction as investors would like. Neither is Onglyza, and Farxiga was rejected here in the US, although it is expected to be approved on the second go-round. There are rumors that AstraZeneca may buy Bristol out of their diabetes partnership if Bristol really doesn't have that much interest in continuing it. Now, neuroscience hasn't really been a source of major growth post-Abilify, which didn't even come from Bristol's R&D to begin with, but its partner Otsuka. Alzheimer's has been a drug graveyard for drug development, although Bristol does plan to proceed with one tau-based program. So where is Bristol shifting its focus? Immuno-oncology, number one. Hepatitis B, HIV, heart failure, and fibrotic diseases. Let's start with immuno-oncology. It's the biggest. It was the one that was singled out with its own bullet point. Bristol has nivolumab. It's a PD-1 drug. This is just the tip of its immuno-oncology spear. It's creating a whole regimen by combining nivolumab with other drugs that they have, including Yervoy, which is approved, but several others that are in development. It will have competition. Merck has a PD-1 drug that is a little further back in development. AstraZeneca has a PD-L1 drug, which is similar but goes through a slightly different pathway. Now, AstraZeneca, I would say, is second behind Merck when combining their PD-1 drug in combination with a CTLA-4 drug. This is what Yervoy would be for Bristol Myers. So it's going to be a competitive space, but it's going to be a huge space. This is really what's driven Bristol shares higher for the year. So bottom line, this really isn't as radical a transformation as it may look on the surface. In fact, I think it's just smart business. So let's move on to our final story of the day, which is Obamacare. And I'm sure everyone has heard President Obama's much repeated line that if you like your insurance, you can keep it under the Affordable Care Act, or Obamacare. But for about 5% of the population, this is absolutely false. Completely untrue. And now we see President Obama acknowledging that reality and apologizing for it. So what is true is that most everyone gets to keep their insurance. Those on Medicare and Medicaid or employer-based coverage won't change, and that's 80% of folks. But it's not everyone, and some of those on the individual market will have their plans revoked. This is not a bug or a glitch. It is a feature of the Affordable Care Act. These are plans that don't stand up to the minimum standards of Obamacare, whether that be in regards to coverage, benefits, or expenses. However, these people may feel sticker shock when they go to the state-based exchanges and see what plans are out there for them. Their bare bones plans that have been revoked will likely have been a lot cheaper than what is now available on the exchanges. Now, some of these individuals may qualify for subsidies, so it may not be as bad as it originally appears, but they likely will be paying more but getting more in the process. What is critically important for the success of this program and for the Obama administration is to make sure that the exchanges are functional at the end of the month as they have promised. Now, Oracle and Google have been enlisted to help United Health subsidiary Quality Software Services get it back on track. The much maligned CGI Group is still very involved, but it has been pushed back off the front lines a little bit. And I think something else investors need to look at, and people who have lost their plans and are being apologized to, is that the bronze plan prices have been pretty low on a lot of these exchanges, and that's because the large insurers have been incredibly competitive here. They've been focusing on the bronze plans because they feel like that's where the healthier customers will be shopping. They'll be looking for the lower monthly premiums, and the sicker people will go to the more comprehensive platinum plans. I'm going to dig deeper on this topic a little later and give some better comparisons, but when you're taking a look at these companies, Aetna was one in particular that pointed out how they were really trying to be as aggressive as possible with their bronze plan pricing, but not be as competitive at the platinum level. It's a really interesting approach and probably a really smart approach when you're talking about their risk dynamics. So stay tuned for that, and for more Obamacare and healthcare coverage as well, come back to Fool.com. We've got you covered. Thanks for watching, and Fool on.